Hello traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical, driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next half an hour, 40 minutes or so. We'll start off with a general look at markets, how they're shaping up to kick off the week. Of course, we'll just have a brief thought on just the idea around what we've seen in the last 10 days or so with multiple central banks. We'll then look at stocks and see how they're shaping up and look at the technicals on the S&P, the NASDAQ and the Dow. We'll then, after that, get into last week's main events. Of course, the Fed, we'll review that and the implications for policy, what that means going forward for the dollar as well. We'll look at the 10-year Treasury chart as well, before then reviewing the Bank of England meeting as well, looking at cable, so sterling against the dollar, and also then the Bank of Japan meeting and dollar yen. After that, even we'll look at the main events of this week, some inflation data coming out of the Eurozone and also the US. Okay. Firstly, how markets are shaping up currently. Global markets, continuing really to feel the heat from these surging dollar, trading at near 6-month highs, of course, and surging US Treasury yields. That, of course, follows the Fed meeting and their hawkish hold last week. It was actually the worst week since March for the S&P 500, though futures are relatively stable at the moment, slightly in the red now actually, after Asian stocks fell overnight, led by a tumble in Chinese property developers amid really fresh worries about the China Evergrande group. Remember, China's property sector normally accounts for around, over 25% of activity in the world's second biggest economy. The sector has stumbled this year, of course, on consumer demand really struggling. This week, we do get several Fed speakers who are probably likely to repeat this higher for longer message. We've been talking about this for a number of weeks, number of months now. But we also have, it's month end. And we also get the possible risk of a US government shutdown. That will probably go to the brink still, as these things normally do with politics. And also to keep an eye, we will be keeping an eye out on the strike, the UAW strike in the US, with auto workers potentially dampening sentiment as we go through the week. We just thought we'd mention just one thought that we've had just around what we've had in the last 10 days or so. We've obviously had 3 major central banks really making policy decisions that kind of seemed fairly balanced, didn't they? They could have gone either way. If you think about the Fed, they unanimously chose last week to hold policy rates unchanged, but they kind of went out of its way to suggest that they may raise rates again, of course, at its next meeting. Bank of England, they stayed its hand. The voting pretty much split down the middle. Observers, really us as well, increasingly think the peak now has been reached. And then the previous week we had the ECB raising rates, but into that bleak economic growth picture. It's really then this deepening uncertainty about what policymakers were going to do is not really that hard to understand, and it's linked really to that deepening doubts about what they ought to do, in fact. And really now we're at this sort of time when signals from both price pressures, price movements, and economic activity are basically becoming harder to read. And that, for us, increases the scope for error. And really then the chance that, as well, major central banks will now start to diverge, so be different in their policy approach after, of course, what we've seen over more than a year, which has kind of been synchronized tightening part of rate hikes. So this difference will be interesting potentially for FX as well, for markets. And one other reason for that divergence as well, just sort of talking economics, just is because of the supply side drivers of inflation. So before we had sort of more global factors around pandemic dislocations, of course, Russia energy crisis, of course, and then commodity price wars. But that's kind of now fading, and really now price risks are sort of more domestic based, and again that will potentially see more divergence going forward as kind of policymakers potentially they focus on wage growth, which is what we've been seeing, but that is key. And then potentially if that stays high in certain countries as opposed to others, then that would prevent services inflation, core inflation as well, prevent that from following the headline rates that we've seen falling as well. But all to do with potentially more specific factors rather than this synchronized tightening path that I said that we have seen for over a year previously. That's just a thought. We always like to sort of touch on wider themes if we can, and potentially what to think about going forward over, as we say, a sort of bigger theme. Okay, let's now move on to stocks. Kind of enduring quite a difficult time at the moment with these rising yields. Of course, Friday we saw another choppy session, really, that capped a week. Equities, as I say, dragged down, well, both by rising yields, of course, rising oil prices, as well as growing expectations, of course, that interest rates, those rising yields mean their rates will stay higher for longer again, that phrase. Wall Street's benchmark, of course, the S&P 500, that closed down 0.23. You can see on Friday that shared around 2.9% over the week. The tech-heavy Nasdaq, so that dropped a small 0.1% on Friday, taking its weekly loss actually to a bigger number, 3.6% around that number last week. Both indices now, as you can see on this weekly chart, they've fallen for 3 consecutive weeks. And stocks really, if we go to, well, this is the weekly, but if we go to the daily, you can see stocks really sold off Wednesday, Thursday sharply as those yields reached their highest levels actually since before the financial crisis in 2008. And that was really spurred by this hawkish policy guidance from the Fed. We also had that out on Friday. Suzanne Collins, president of the Fed's Boston branch, reiterated really that interest rates will stay higher for longer. That phrase again, sorry. And also then San Francisco Fed President Mary Daly said inflation is unlikely to fall to the central bank's 2% target in 2024. Just then stepping back to the, sorry, just checking what you can see. Just bear with me 1 second. Apologies, you're not being able to see this chart, which we'll get to now. But just on the daily, this is the daily S&P 500 chart, the benchmark broader indices. You can see that sell-off on Wednesday, Thursday, after the stronger sell-off, as well as then Friday as well, but stronger sell-off after the Fed meeting. If we go to the weekly, you can see pretty poor week, 2.9%, as I said, or so, closing on the lows as well that you can see. So technically, we do have that support from the mid-August low at 43.35. But as I said, we closed on the lows and below that at 43.20. So potentially not looking great. You can see for us, next support is probably that rising trend line. And then the 100-week moving average, that gray line, which is around 4,200. So potentially, if we lose this, start lower, then we're looking to go to 4,200 or so on the daily. You can see us losing the 100-day moving average, also losing that mid-August low at 43.35, and then closing pretty much on the lows for the week, as I said. 43.16 was low on Friday. So if we do move lower, as I said, we've got that rising trend line just above sort of 4,200 or so. Then you do have the 200-day moving average, that thick black line there, just below 4,200 at 41.90. So that will be widely watched, widely touted, probably in the wider media for sure, the 200-day moving average. If we just sort of stem back there, you can see it's kind of acted as resistance, support. So just watch out for that around the 4,200 mark in the S&P. As for the NASDAQ, sort of closer lines of support potentially. You can see the mid-August low. We haven't quite beaten that yet. So that's a 14,557. This is NASDAQ 100. Otherwise, then we've got a fib level in there, near term, sort of minor fib level retracement at 14,700, just below 14,696. And that's just above, as I say, 14,557, that mid-August low. So potentially some support here, but if we do lose that, then certainly, well, next level of support for us around 14,000 potentially if we do lose that mid-August low. Just looking at the daily, you can see we're just below now the 100-day moving average, still got that mid-August support. We're sitting bang on that near-term minor fib level retracement. The 200-day moving average in the NASDAQ, you can see much lower, around just below 13,500 there, 13,480. Interesting for us as well that we have had defensive sectors really continuing to outperform cyclical sectors, and we can see that in the Dow really. Not as bad a fall, although you can see now we have been touting this sort of support resistance line, previously resistance, now support, or had been, and we've dropped below there now, that line being 34,281 in the Dow. We dropped below there now, so we do have a couple of long-term moving averages, the 100-week and the 50-week as well, around, you can see 33,647, 33,535. Potentially now, if we have lost that 34,281 level, then we are going lower, and that now acts as resistance again. You can see the black line again, that's a 200-day moving average. That's at 33,808. So again, could be touted, especially in the media, but it does prove to be quite significant. It acted as support, you can see previously there, and kind of support when we dipped below for a few sessions, but then pushed above again. So interestingly, interesting whether we do that acts as support again. That's at 33,808. Okay, let's go to now last week's main events, which were, of course, the Fed. Just bear with me 1 second. I'll just pull up a couple of graphics first of all, which you could see here. So yes, the Fed, well, generally, of course, massive week. It was last week, a bumper week where really for central bank meetings, we had to contend with no less than 6 developed market central bank updates. We had, of course, the Fed, the Bank of Japan left rates unchanged. Sweden's Riksbank and Norges Bank, they both hiked, while the surprises really were from the SNB, the Swiss National Bank, and of course the Bank of England, both of which decided to leave interest rates unchanged rather than to increase them. For the Fed, obviously last Wednesday, they maintained rates at 5.25% to 5.5%, widely anticipated. However, for markets, the guidance, we said this last week, the guidance was on what was to come was key. So Chair Powell, he indicated that the Fed had reached a point where it can proceed carefully in determining what rate will be restricted enough to bring inflation back to target, but there is still more work to do. He delivered, essentially then, the Fed delivered a hawkish hold with clearly stronger than expected economic forecasts that marked a real surprise for markets. So the Fed, they revised up their 2023 GDP forecasts to 2.1% from 1%, and in 2024 to 1.5% from 1.1%. They then left the 25-26 forecast at 1.8%. The peak in the unemployment rate has also been put substantially lower, really, to 4.1% from 4.5% in 2024-2025. And then despite the stronger than forecast growth, inflation is seen still cooling largely in line with earlier forecasts. So that means expected headline PCE inflation slightly higher this year, 3.3 from 3.2, unchanged next year. And then core inflation was put slightly lower at 3.7% from 3.9%, and then unchanged the following years, before returning to target in 2026. So Powell, he made it clear that the more upbeat outlook warrants maintaining rates higher for longer, which was also visible in these updated rate projections, the dot plots, and those are here. So 12 out of 19 FOMC participants called for one more hike in 2023. That was kind of expected with, of course, the economic resilience we've seen, while then the 2024-2025 median dots, this is crucial, they were revised up by 50 basis points to 5.1% and 3.9% respectively. So if you remember before, they were at 4.6%, so pretty much 100 basis points of cuts were expected in June. Now those have been reined in only to 50 basis points of cuts, taking that median dot plot up to 5.1% for next year. So a key factor driving this renewed hawkish market reaction, of course, during the press conference was as well, we should point out, Powell's kind of surprisingly open view regarding a potentially higher neutral rate. So while the longer term Fed funds estimate was unchanged at 2.5%, Powell mentioned that it does not necessarily suggest that that neutral rate could not be higher, which in turn then suggests monetary policy is not as restrictive as previously thought. That was a surprise, and in our, you can see the sort of all these numbers that I've just sort of pointed out, really, that jump in the GDP forecast there for this year, still higher next year, unchanged really after that, but then also this Fed funds rate staying next year going up to 5.1. You can see 50 basis points of cuts reined in, and also similar in 2025. So interesting, really more hawkish than markets had anticipated. Yes, was quite a shock for markets, as I say. I just want to pull up a chart now, which is just bear with me, the 10-year US Treasury yield. We don't often look at this, but definitely worth looking at the moment. Just bear with me 1 second. Which is, of course, just sorry about this, just bear with me. Which is here, which you can see. So you can see really, how 10-year yields really moved after the press conference, actually. We could just drop down to the 1 hour chart just to show you that. So you can see that. You can see that certainly this big move higher during the press conference, during the FOMC meeting, yields really breaking high, and you can see breaking that previous high around 4.36% on this 10-year Treasury yield. And in fact, all maturities up to the 10-year sort of period, they jumped to new cycle highs, and you can see that here. Well, that's on the very short dated chart, and you can see them pushing above that sort of 4.33 level that we had highlighted hopefully before, going way back to October 2022, and then just this push higher, surge higher in yields, bond prices coming off, and we're now pushing up to 4.5% in this 10-year Treasury yield. That meant actually 10-year real yields surpassed the 2% barrier as well, which was key. And then certainly after the press conference, just looking at the market reaction, dollar pushed higher, euro dollar dropped from sort of 107.30 down to 106.60, and dollar yen cleared the 148 big figure handle as well. All of that, of course, a stronger dollar, higher real yields, really then the reinforcement of this narrative, higher for longer. That is, of course, now you know, and that also then hurt equities. S&P down nearly 1% on the day, Nasdaq down 1.5% on the day. So certainly, main message. I'm sure you've got it now. The Fed trying to engineer hope for soft landing. That means governors see far less room to cut rates next year. And with the revised dot plots, of course, the Fed is saying if we have stronger growth for this year and next, it increases the risk that core inflation does not fall as much as the Fed hoped and expect. And then that means there is a potential need, to keep nominal interest rates somewhat more elevated than previously forecast. We would say, though, and we said this actually on previously last week for sure, the higher for longer stance, yep, it sounds pretty plausible now with the resilience that we've seen in the economy, but the one more hike is kind of more questionable to many as well. And simply because we've had tightening financial conditions through the summer, that means higher borrowing costs, less credit availability, and then we've also had some headwinds as well in play. As I mentioned, the strike, the UAW strike, potential government shutdown as well, possibly. That's very near term. But then we also have other areas like the restarting of student loan repayments, potentially impacting on household finances, and then also then possibly rising delinquencies in credit card loans, auto loans as well. Hurting the consumer and activity going forward. But certainly it's these higher mortgage rates, higher borrowing costs, and then less credit availability, as I said, will hurt activity going forward, we think. The Fed, let's not forget, of course, is still very data dependent. And it's just whether now these forecasts that they have given out around growth, around unemployment, whether they're too optimistic, as I said, because of these other factors potentially hitting activity. I think one economist called it, and I quite like this, called it Goldilocks, the scenario with the Fed's projections, Goldilocks without the bears. So we shall see. Obviously, the economic resilience, as I say, has been surprised virtually everyone. So it's just whether and how long that will last, I guess. So that's a 10-year Treasury yield. I was going to look at the DXY, but we'll look at that shortly, actually, after when we look at the US core PCE data. Let's move on now to the Bank of England meeting, which is, just bear with me 1 second, really interesting. We had the UK CPI report the day before, if you remember. So Wednesday, that came out last Wednesday, and that really surprised markets, surprised everyone really, with a quite dramatic fall in inflation. You can see here, headline dropping 1/10 lower than the July figure, but below the 7% increase. That's the headline. But we saw a load of different categories falling quite sharply, including food, accommodation, as I've put here, vehicle prices as well. And then more importantly, probably the core. So that strips out those volatile food and energy costs, as I've put it here, better gauge of underlying price pressures. And that fell sharply from 6.9%. And well below the expected 6.8%. And in amongst that was services inflation. Again, we've talked about this widely previously. That's the key metric for the MPC, and that fell again sharply below 7%, below the bank's recent forecast of 7.2%, and from the previous 7.4% to 6.8%. So big numbers there, and that really changed then the outlook for and the odds on the rate hike that was probably in the balance, but more favor than not before those CPI figures. Then it was really a coin toss, and below that actually for the Bank of England to hike or not. Certainly they kept rates then unchanged at 5.25%. Forward guidance remained broadly unchanged as well. As I mentioned about the vote, 5 members voted for an unchanged decision, 4 voted for an increase of 25 basis points. Just looking at it in more detail, then the majority cited the downside surprises I've just talked about to inflation and further signs that the labour market was loosening. The BOE, they now expect GDP actually to rise only slightly in the third quarter of this year, and underlying growth in the second half of this year also likely to be weaker than expected. Likewise, the Bank of England sees or expects CPI inflation to fall significantly further, while noting services inflation is projected to remain elevated in the near term. But again, we highlight that still below their recent forecast. The MPC, the bank, basically reiterated that the current monetary policy stance is restrictive, and that, and I'm quoting here, monetary policy will need to be sufficiently restrictive for sufficiently long to return inflation to the 2% target sustainably in the medium term, in line with the bank's remit. So pretty much unchanged forward guidance, but keeping the rates unchanged at 5.25% was a surprise. Of course, there is still potential for a hike further out, and I think it was interesting for us anyway that the odds were still fairly in favour of that happening. But we kind of thought if they're pausing now, certainly a rate hike further out will be tough, and that's of course because of the data we get still showing further signs of weakness, inflation kind of leveling off now and moving lower potentially, and then we've seen this peak in wage growth or specifically private sector wage growth as well. Interestingly, going forward, we have to note data releases are limited before the next Bank of England meeting in this on November the 2nd. So a few weeks away yet, but we only get a few data releases. Remember that. So we only get one job market wages report, and we only get one inflation report for September. So really you kind of think if they haven't moved now, then potentially with those with that data most likely going lower as well, you kind of have to get a big massive upside surprise really in those 2 data points to change the MPC's views and then hike rates. So for us, the peak is probably in, and it means they hold rates then in November, and that means then, as I say, the end of the UK tightening cycle. Also interesting as well, one MPC member, that's Cunliffe, who voted for a hike, is leaving the MPC, and markets really were unsure how his successor, that's Sarah Breeden, will vote, whether she'll vote in the same way or not. I know that some people have talked about whether she votes with the consensus, as she's unlikely to want to rock the boat initially, at least. Markets kind of agree with that, pricing only a 25% chance around that. I think probably less now, slightly less, of a November hike, and just slightly higher than that for a hike by December. Okay, let's just show you then cable. Just bear with me 1 second. I'll just get up that chart, which is here. So yes, pretty depressing for sterling for sure. Sterling actually now the worst performing G10 currency in the third quarter. And that's all really down to this massive repricing we've seen in those rate hike expectations, which was sort of coming into last week's meeting anyway. And then, of course, we've had the pause. So we've had another break lower. This is the daily chart. You can see I probably should extend this descending bear channel that is still good. And we've been highlighting that. So hopefully you've been acting on that, we would say. We certainly have been, but you can see after this sort of peak, above 131, 131.42 was the high back in mid-July, and then this series of lower lows, lower highs, descending bear channel, lower prices. Broken through, of course, that 200-day moving average. That's now at 124.35. And then just this strong dip lower you can see on the Fed, and then of course with that pause decision by the Bank of England. Interesting, we're now at the bottom of the bear channel. You can see the lower end, so whether that actually acts as some support, we shall see. We've got long-term fib levels in here as well. We're below that 123.14 and 61.8 of this uptrend, so that's interesting now below that, and then potentially, well, as I say, bottom of the bear channel, so whether that acts as support. Otherwise, many touting sort of 120 as a target. I know even some investment banks putting out today 118, I think 118 that is, but potentially just watch the technicals. We're oversold on the daily. Not so much on the weekly, you can see, but on the daily we are, so possibly some sort of stabilization, at least consolidation around here. Doesn't mean we can't, of course, go lower still. Okay, that is sterling and the Bank of England. I mentioned actually some of the data, and we did have the PMIs out on Friday. They were grim. Services, especially 47.2 from 49.5, lower than expected. And the survey that's showing employment actually now falling at its fastest rate since October 2009, excluding, of course, the pandemic volatility. That all means that domestically generated inflation likely to slow as well in the coming months, and that will then push the services CPI lower, which is key for the Bank of England. Okay, that is the UK. Hopefully that's proved of some help. No questions actually from you guys, so please do ask any questions that you do have. Let's just move on to the Bank of Japan now and look at dollar yen quickly, which is here. The bank, yes, unanimously decided to keep rates and policy settings unchanged on Friday. That was the results. Bit of a disappointment given that there wasn't any clear sign of a shift in stance either from the statement or from Governor Ueda's comments. The Bank of Japan statement basically maintained most of the wording from before, kept its forward guidance unchanged. Firmer than expected inflation, not enough really for the BOJ to tilt its policy stance. Basically still believes inflation and the rises we've seen are transitory. Interesting that the recent inflation data, for sure, that showed price pressures to be kind of more stable and stickier than expected. Headline rose to 3.2% versus 3% expected. Core remained at 4.3%. That was for a second month. And will be interesting. We do get inflation figures out on Friday, but we also get updated forecasts from the bank at its next meeting in October. So whether that gives them some scope to possibly change a policy tweak, possibly, and there is speculation around that. Expect that to ramp up certainly into that meeting in October. But of course, we have been let down, and the Bank of Japan is certainly being very careful, very cautious, really, and especially after Ueda's comments from a couple of weeks ago as well. Dollar yen, you can see then, especially with these US Treasury yields going higher, that's pushing this pair certainly higher, above 148 now, which seemed to be sort of resistance, and we were oscillating around that. If we just go to the weekly, then you can see now we're into, of course, intervention territory again. We had some jawboning, I think, over, within the last couple of hours or so from another Japanese official. 151.94 is that spike high from October when they, of course, intervened, spending sort of 70 billion worth of yen on, defending the yen. So just watch it around here. I guess we're slightly overbought now. Not quite on the daily RSI, but yes, potentially just watch for that and a possible correction in the dollar yen. Okay, let's moving on to this week now. Just let me pull up a graphic. Doing quite well for time. Just bear with me 1 second. The graphic is here. So first of all, core PCE. But just before actually we get to that, we do get personal income and spending figures for August on Friday out of the US. That's key really because it shows economic activity by consumers, and that's key certainly for this soft landing scenario. I'll pick up an average hourly earnings and aggregate hours work suggests kind of a firm increase in personal income last month. Actually could be the strongest increase since January. Just shows you that strength of the consumer strength in then some of the figures we've been seeing. And then despite a decline in vehicle sales, new vehicle sales, that is another solid increase in consumer spending is expected, albeit growth is likely to have been inflated by higher prices. So moving on to the core PCE, this is obviously the Fed's favored inflation gauge, basically gives us a wider perspective, including businesses. Analysts expect PCE prices will rise by 0.2% month on month in August, matching the rate seen in July. Of course, we'll be framing this data within the context of the Fed policy, really to judge whether then the Fed will follow through on its projections of another hike, of course, this year. So 0.2% month on month increase. And then whether that's enough, whether we see the annual figure falling as well. Remember those projections were lowered for the PCE outlook. And as I mentioned, I think it's not until 2026 that the Fed sees both the headline and core inflation back at 2%. But Powell was encouraged by the last 3 inflation reports. But of course, he still wants to see more than just 3 good readings, really. So you can see the chart here. If I just move on to, I said we'd look at the DXY, which is critical. Of course, this is the dollar index chart. Just bear with me 1 second. Here, and you can just see these remarkable 10 straight weeks now of gains in this DXY chart, up, where are we? Over 6% now from the lows in July, just about 10 weeks, up 10%. And we're now, interestingly, 10 straight weeks of gains, as I've said in the weekly commentary that we put out on, earlier today. That is very rare for major currencies. So interesting where we go from here, but we still quite haven't broken these March highs. The March high in the DXY at 105.88, we're still below that March high. With all this sort of bullishness, hawkishness around the Fed, and we haven't broken that high at 105.88. So interesting, does look solid, really nice uptrend, slightly, not quite yet overbought on the daily RSI, but up 6%. So interesting whether we do break here, then we also have actually, you can see a retracement level 105.38, which we have broken. Next one is the halfway mark of this decline, 107.17. If we can break that 105.88 mark on the DXY. Okay, finally, let's move on to the Eurozone data, inflation data. Just pull up a graphic. Just bear with me 1 second. The graphic, or the chart at least, is here that you can see. So just showing you obviously the dramatic fall in the headline and core probably rolling over now. Consensus sees the headline declining quite a big amount, 0.6% now, the headline, down to 4.6% from, of course, 5.2%. The 4.6 would be the lowest rate since October 2021. So back there, you can see. And then the core inflation numbers also forecast to moderate 0.4 percentage points to an 11-month low of 4.9%. Just headline, and that will take a notable step down this month, not least because base effects associated with last year's heavily discounted German travel pass that will fall out of the calculation. And then base effects related to last year's, obviously, energy and food price shocks will more than offset the impact of this further rise in the price of auto fuel. Just to note as well, ahead of this release, we do get preliminary inflation estimates from specific countries, so Germany, Spain, Belgium as well. They're due for release on Thursday. So for the ECB, the release probably won't impact significantly on pricing for its October meeting. That really markets assign around, I think, around 90% chance deposit rate will be held at 4%. Of course, if the release comes in below expectations, and given as well Fridays, we saw soft September PMI data as well, that could possibly bring forward then market expectations of ECB rate cuts. Now we're talking about, I think the first 25 basis point reduction is currently priced in around July next year. So interesting, this shift then that we're seeing, obviously hikes now. Possibly it will, whether it's sticky, then we get possibly some pricing in of that by year end, but otherwise a lower than projected figure will spark possible cut scenario, but of course that is middle of next year. Okay, let's just look at euro dollar, kind of the opposite chart to the DXY chart that you can see here. So again, really nice bear channel, really series of lower lows, lower highs. You can see from that high close to 113, 112.75 mid-August, and then the steep drop. And where are we? We're just sort of still hovering, similar to that DXY chart. Then we still haven't conclusively broken that May low at 106.35. We're trading pretty much on it. And last week, though, you can see buyers stepping in around 106.10, well, 106.14, 106.16. And we've got this retracement line in here, which is 106.10, which is the 38.2 of this decline. So interesting, 106.35, 106.10, this area of support potentially. We noticed that futures positioning in Eurodollar net longs, they scaled back further actually, and fell below 15% of the open interest for the first time since October 2022. So yes, 106.10, 106.35 is a key zone of support potentially. Otherwise, we lose that and we're going down to probably 105. And you can see these lows here from sort of March, mainly March and late February, around just above 105. Okay, hopefully we'll wrap it up there. Hopefully that's proved of some use to you guys. No questions that I see. But please do just bear with me 1 second. Please do follow us on social media, of course, and also we publish a daily commentary which has just thoughts on the market, of course, what we're looking at in the day ahead, and then also a chart for the day. Okay, take care out there, and we will speak to you next week.